Real quick, before we jump into the show, we created the Collecting Keys podcast to be a real estate investing podcast that is created by real estate operators for real estate operators. And we want operators everywhere to know what it really takes these days to be successful in this business, rather than all the fluff that all the other content creators and podcasters out there make. And so one of the challenges with this is that it's challenging to grow because most operators are too busy out there working, right? And they aren't always learning or actively seeking new learning material. And so if you could please share this show with any fellow operators you can text it to them, you can post it on your socials, you can leave us a good review that you then share somewhere. That would be amazing. But really, whatever, it really helps us continue to get excited to create content. And it will also help you because everyone that you expose us to will get better as a real estate operator and close more deals. So if you could do that for us, it would really mean a ton. And otherwise, we appreciate you guys. And let's get into this episode.
Well, everybody keeps saying like, oh yeah, I'm waiting for the buying opportunity, right?
It's right now. What is going on, guys? Welcome to today's episode of the Collecting Keys Real Estate Investing Podcast. This is the show by real estate operators for real estate operators so you can continue to grow and expand your real estate business in the ever-changing economy. And we are having a interesting time in the economy right now. Just big picture, how it's going to affect real estate, we don't really know. So as times of recording, we're recording this on the 8th of April, so a week before you guys will hear it. So things could completely change by the time this episode comes out.
They likely will.
But we are currently in the middle of a little stock market free fall. All the tariff stuff like spooked a bunch of people last week, and we've had the biggest, at least this is what it said last night when I was looking, the biggest like 2-day drop since like 1987.
A 3-day, but yeah, I think you're right.
Of the stock market. And so
it seems like a really weird stat though. Like what about the biggest 2-day or 4-day or 5-day?
Right.
Like what?
Yeah, what if the 1 day was bigger than the 3-day, right? Like,
well, there's definitely been bigger 1 days than 3 days. So it's like, what's the stat here?
That's why stats in general are always stupid, right? Because you can compare them to whatever you want.
Exactly.
And you can spin them in either way to make them sound not so bad or way worse than they actually are. I mean, regardless, stuff is hemorrhaging pretty bad.
Yeah.
Boeing's up. I'm watching Boeing.
That's how you know things are fucked, right?
Right. Well, they just got a contract. What contract did they get? They got some sort of like defense contract. So that's why.
Really?
Yeah.
I'm surprised by that, but
yeah, me too.
I mean, just based off of their track record, great. Now we're going to have, instead of the commercial planes flying into the ground, it's going to be all the fighter jets that just crash for no reason.
Yeah, their door just falls off mid-flight.
I think that's what it was. They got the new 6th-gen fighter jet, and I was like, why? Like, what are we doing? What do we need these for?
It's a problem. They're going to be having these jets that are learning with like AI on the internet, and all they do is look up planes and see 9/11, and they're just like, fuck, I guess that's what we're supposed to do.
Oh my God. Jesus, that's dark.
Say AI is pretty stupid. It's been spitting out some dumb stuff. But it's been a big question around real estate with how this is going to be affecting everything, because the 10-year treasury, which is what a lot of mortgage rates are based off of, took a big dump on Friday. It's since rebounded up, but there's been an overall conversation going on around what is this going to do with interest rates. And from what I've read too, that's kind of like the goal with driving the stock market down, is they're hoping to bring interest rates down, which will in turn make things more business friendly so that more business production happens, since they're trying to, bring stuff back stateside again. Whether or not that actually happens, I don't know.
The previous administration, I mean, really the past 10 years, but they loaded up on a bunch of like short-term debt. It's like 2-year treasury bills, and those are all coming due. And so that kind of the theory is like, we need to get these down so we can refinance this debt and save, honestly, like billions of dollars on the interest expense.
A lot.
So the federal government went and did what all the multifamily and commercial investors did and bought short-term arms.
Right.
Yeah,
right.
Pretty much, dude.
Yeah, exactly.
Yeah, nice. Yeah, that's fun.
Which is just stupid, because they could control interest rates, and when they were zero, they could have issued a lot of debt for like a long period of time.
They could have bought a shit ton of debt. Yeah, right. I mean? That it's all at different durations.
50, 100-year, 30-year. It's your fucking debt.
A lot of corporations, like the Apples and stuff of the world, did that, though. They're sitting on like...
Because they're fucking smart.
I think corporate debt, the longest it goes is 15. But like, I think they have like the 15-year debt that they have like locked in at the 2-3%.
You could go longer, right? Because Disney issued a 100-year bond back in was it the 70s, 80s?
So I think that's different than I don't know. Maybe you can. I don't know if you can do that in today's world or not. I thought the most standard was 10 to 15.
I mean, there just might not be an appetite. It's just unheard of, right? But if I think it was in the 80s, Disney issued a 100-year bond, but it could reprice, which it did. I think it was like at 50 years, it could reprice. And they issued it at like 9%. Could you imagine having a bond at 9% today? Like that. And when I learned about it when we were in the ZERP, and I was like, dude, that would be dope. Like, just 9% fixed interest every month coming in.
Yep.
Well, stuff like that would just never happen now because with the internet and just the rate things change, there's no appetite for it. People don't even want stuff that's more than, 3 years or 5 years a lot of the time. Like that's one of the reasons, like with our lending business, we have all these co-lenders. That's been very interesting to people is because our loans are typically like 6 to 12 months. And the fact that people can get like a higher fixed yield for a year or less, they're like all about that. The interest, like the time frames that people have, I think especially when times get weird, are significantly shorter because people are also worried about having their money tied up if there's a buying opportunity.
Yep.
Right.
Well, everybody keeps saying like, oh yeah, I'm waiting for the buying opportunity, right?
It's right now.
Right. Well, a lot of people have said this like just over the last several years. And it's like, yeah, it is actually now. But then what happens is uncertainty and people don't want to invest during uncertainty. And it's like, see, you aren't buying when you're supposed to be buying because you're a pussy.
Yeah. Well, totally, dude. I mean, that's a legitimate statement. Everyone's been saying that forever is they've been.
It's here, baby.
When stuff corrects, they're going to start buying. It's like, that is the time right now.
I mean, depending on which vantage point you have, if you're an off-market operator, have an off-market business, this could be the time where, I don't know, if you're a baby boomer and you're seeing your portfolio go down, but you have, 1 rental property, 2 rental properties, in my opinion, that person might be more likely to sell now than they were, a couple of years ago.
Right. Yeah. Things aren't as rosy, right? You want to hold when things are great. And then when, people, the instinct is to sell when they don't feel so good.
A flight to cash, right? They're like, I'd rather just have the cash in this real estate.
Which is like a super bad situation. And I know of personal experience with folks during like the 2009, 2010 financial crisis that they were watching their investments go down. And so they went 100% cash after they lost like 40% of their wealth, retired people, and then had to go back to work. It's like, that is the dumbest thing you could do. So say you're 62 years old. I actually heard this argument. I thought this was the dumbest argument I've heard because they reminded me of this story of like, if you're retiring this year, the economy is just killing you. You're not going to be able to retire. It's like, yeah, but what about the guy that retired 5 years ago and that guy that's going to retire in 5 years? We're all in the same position because if you're choosing a retirement age in the 60 to 65 range and you're going to live reasonably long, because like if you have a retirement, you're probably going to live longer than people that don't. Right? So say you're going to live till you're 85 or 90. You can't just not invest today because you're retiring. That's just a really poor argument. It sucks that your income's going to drop, but if you can't retire and weather a storm, you're not going to be able to retire in 10 years either because you just don't have the money to do it. So it's a really poor argument for what the economy is doing to a 62-year-old. It just sucks in general for everybody, but you have to stay invested.
Yeah. Well, I've seen people like on X or Twitter, like, I can't believe all these people are rooting for a downturn. And what are we supposed to do? These people are retiring. And one, you've had the best time to invest for the past 40 years. If you're
a baby boomer, if you fucked up, like if you can't retire.
Yeah. Hot take. If you're a baby boomer and you aren't financially secure, you're an idiot with your money.
Yeah.
If you're down 40, 50% the past couple of days and you're like near retirement age, you're probably just too exposed to equities.
Yeah, exactly.
Your balance is not where it should be for your goals. That's the biggest thing.
The other point though that I'm trying to make is like, just because you retire doesn't mean you stop investing. Like you have to stay invested. Like if you go cash when you retire, you're screwed. If you go 100% bonds,
yes,
you're going to run out of money unless you have, a lot of wealth and your living expenses are so low. So it's just, yeah, it sucks, but it sucks for everybody at the same exact amount of time.
Yeah. Well, and then also too, a lot of those people, they probably own a primary home. I think a lot of people that are at like that retirement age have that, so they have another nest egg there that they can tap into if they need to.
Right.
Even though I tend to fall a little bit more liberal, I always have this issue on the liberal side is they always look at like the most extreme sob story for everything. I'm like, okay, bro. They're like, we need to change the entire situation in the world because there's like trans kid at my high school of 2,000 kids. I'm like, there's a fucking one.
Yeah. And he might not be trans next year.
Yeah. He just really wants attention.
Yeah.
And then there's like the same with like the older people, like, well, what about the people that are retiring that now are going to not be able to retire as comfortably? It's like, well, There's going to be some that are crushing it, that are fine. There's going to be plenty that had zero retirement anyway, so they were fucked regardless.
I think there's some level of like, in that same vein, I think there's just some level of arrogance of like, I think I know what's best for you.
Yeah.
Right. And so this is me projecting what I think would be good for you, not for me, but for you. And then trying to create some sort of story or policy around what would be good for other people. It's like, well, start with what's good for you and then look outward, right? Like if everybody would just start there, like we all probably kind of need the same thing-ish.
For sure. Yeah. And ultimately, I think the big thing with it, you and me talked about this the other day, Dan, is what you should be focusing on is instead of what the economy and everything else is kind of doing like big picture and trying to project these outcomes that you can't possibly project, just focus on getting better at your own skills.
Things that you can do.
Learning to make more money, being able to find people that are still going to be operating, doing business regardless of the environment and do business with those people. Because the one thing you can control more directly, especially if you're a business owner, is your income.
Yep.
Right? And you know what? Income means more revenue. Revenue solves all problems. That applies to your personal life as well as your business.
Especially small business, man. Like small business, it goes back to like markets are local too. And like, what is your business and what are you trying to sell? Or, what is that product? You can actually really control that quite a bit in a downturn economy. Like you could sell kind of anything and it depends on what area you're in. Is it going to be good or not? Like I always use the experience of like coffee. Like people are like, oh man, that's the first thing that people give up. It's like, not really, because those are some of the best businesses that boom during down times because people still want a $5 or $6 cup of coffee at a Starbucks or a drive-through coffee stand. People still want to buy cigarettes. They still want to buy alcohol. Like those are all fringe things that you don't need, but people still buy them. And what do they call that? Recession-proof stuff.
Yeah. Well, I think the key is having in real estate, it comes down to having those exit strategies, right? Like what is probably going to happen, or we're trying to see it happen, is investor loan interest rates, DSCR loans, are now dropping below Fannie Freddie loans, which is weird in terms of interest rate.
That is weird. That's super weird.
Like Fannie Freddies are sitting in like the mid sixes. I've been seeing people getting DSCRs in like the mid sixes to even upper fives.
There was someone in the GoBundance, creative finance wholesaling WhatsApp chat today that posted one at 5.75. I think he was buying down the rate and it was a 65% LTV, but still, I mean, that's insane to me.
He's in my pod. Like that's a legit lender, right? Like I actually don't know if he's buying down the rate with that. That's just sort of like how they operate because they have a big fund. But you're not finding that with Fannie Freddie.
What are the DSCR rates connected to? Are they actually connected to the Fed funds rate somehow, or are they just...
So they're allegedly connected to the 5-year, but really at a basic level, they're connected to whoever's willing to carry 30-year paper.
Right. I guess that's my point is like, really, they're not going to float as direct as like an FHA or conventional mortgage, right? It's going to be slightly different.
No, because those get packaged up and shipped off to Fannie or Freddie, where these might be on their books. So like, what's the risk appetite of the lender, right?
Yeah. And I think about this because something that we haven't talked about really is the fact that the Fed has not been buying, and I think they've been selling off their balance sheet of mortgage-backed securities. I don't know if they're still doing the quantitative tightening, but I know there for a while they were selling like big blocks. Every month they're selling a block.
Since 22. Yeah, it's been for a long time.
So like with that being said, is they're not buying stuff. So does that reduce the demand for them? Because there's nobody to buy these shitty mortgages, right? No, the government tends to do it. And we're an economy driven by the American dream of home ownership and all that sort of stuff. And it's very common for people to buy a home instead of rent here in the United States because the prices are pretty close, at least on paper, what it would cost to rent versus own. And so if they stop buying it, then those rates are going to stay higher than these DSCR rates where people are willing to take on they have a riskier appetite to buy these investor loans, which, as we've talked about, they're finding out are not as risky as you would think.
Yeah, well, so especially landlords have additional assets. So even with our lending business, we've been talking to these hedge funds to do DSCR loans for people. They so heavily prioritize people that have experience and that own additional assets.
Yeah.
It's not even like, oh yeah, you get like a 20% better deal. It's like 100% better deal. Like your interest rates almost, 2 to 3% lower.
Once you're 10 plus, they call that institutional, right? Which means I think that, institutional buyers will buy those with no problem, I think is why they call it that.
Exactly. And same if you have like good credit, like that's so heavily favored with these DSCR lenders. And it's because they want people that have additional assets to secure these debt. They want people that have a track record, and that's kind of where it's going.
Yep.
So like keeping that like in your sort of view, even though I've ripped on rental properties a lot over the past couple of years, like it is like a decent time right now that like if you do have deals that are a little bit on the fence, that you keep that open as an opportunity because you could be getting cheaper debt. Because on the dispo side too, stuff is getting weird. Because like we're talking about, there is this uncertainty that exists. You're going to find out really quickly who is actually a good operator and who just spends too much time watching the news and is trying to be an opportunist. Like you had some notes here, Dylan, about trying to dispo some deals and having a hard time finding buyers for different things. We've kind of had the same experience as well. But I think one of the weirdest parts about it has been you almost like can't guess when it's going to happen. Like we've had like some deals that like no one will be interested in that we thought were like laydowns. And then we've had like really shit deals that like people have been all over for some reason, and in hindsight, I wish we could go back and just like see what the headlines were that day when we send them out.
No shit.
Because there's probably like something.
You could go look probably.
I probably could.
Yeah.
There could be something to it. You're right. Absolutely.
I don't know. I'd send like basically to people I've already sold before. So I know they're good buyers. I know they're in my market. And it was like crickets first, a couple of them. And like, luckily they still sold, but it was definitely not the appetite that I was expecting.
Who's that second pass buyer? Like when your guys that normally buy it from you, who are those people that were coming around?
Like if the first round doesn't, I'll do a little bit of mass marketing, but my go-to thing, like I've talked about on the show before, is I'll try to find the cash buyers that are in close proximity to that property and basically skip trace and reach out to them. And that's worked out for me.
Gotcha. You probably have a lot more buyers in Cincinnati than we do in Spokane. Like you might bump into a buyer that you haven't seen before that just bought a deal down the road from one of yours.
Oh, I'm sure there's plenty of buyers that I don't know, but yeah.
Yeah. Okay.
Depending on the market, there's less of that than others. But I mean, like understanding though, sometimes that isn't always an investor though either, right? Like now is like a good time to be doing more wholesale stuff or doing more innovation stuff and actually kind of like creating deals a little bit more and like really understanding those different exit strategies.
Yeah.
Hey, so you've heard us mention our Scale community before, and I don't have a lot of time, so here are the quick highlights. In Scale, you get all of our processes and systems that we use to do about 150 deals every single year. You also get a community of investors that are verified crushing it in their markets, otherwise they wouldn't even be members. And that way you don't have to waste time with non-starters like you find in other groups. You also get preferred relationships with marketing companies and even lenders that will give you 100% financing. If you just heard all that and said, nah, I don't really need it, that's not going to help me, I don't know what to tell you. You're lying to yourself because all of those things are guaranteed to help you explode your business and buy more deals next year. So go to collectingkeys.com/scale and let's see if you qualify. We've talked about this forever, but I think going into the next little bit, if you're a one-trick pony, it's going to be really, really hard to be a transactional real estate investor where you're making money. Like unless you're willing to take on immense risk yourself and buy all these properties and go on the retail market, which we are seeing people really lean into that. But if you don't want to be the person that potentially gets stuck holding the bag, you need to be able to figure out these different exit strategies.
I mean, even on the lending piece that you were talking about earlier, if you can quote unquote burn out a property, let's say you're all in after it's all said and done for $15K, but now you have a 25% equity position, that's break even on a $250,000 place for a year. Okay, sell it after a year, get long-term capital gains, and then like you're still going to make a ton of money on that.
Totally.
But you just have to be willing to wait the 13 months.
Yeah, I mean, and that's another point too, right? Is if you are looking to hold on to stuff, it doesn't. Yes, you ideally wants the cash flow. It doesn't need to anymore for DSCR. Like some of the DSCR lenders, these hedge funds, they'll do it at like a 1.0 DSCR, so they just need it to break even with your taxes and insurance. It's not even including property management, right? Or like there's even ones that will do it at like a negative depending on your market. If you're in like a super hot market, there's ones that will do like a 0.8% DSCR.
So, I mean, they have to be having the guarantor personally guaranteeing those, right? Like,
of course. Yeah.
Oh yeah. It's all PG'd, and they want 4 months of reserves. They want you to put 4 months of payments in reserves, which then just cover your first 4 months of payments. So they're making sure that at least they're securing it a little bit more than just throwing you a loan.
We're starting to see that a lot, even when on the hard money with some of these like institutional hard money lenders, is they're wanting you to do interest reserves up front. They'll pitch it as like, oh yeah, it's interest reserves, you don't have to make any payments. But then what they actually do is if you're getting reno, they'll basically pull the first 6 months of your interest reserves out of your renovation costs. So you don't have to make a payment for 6 months, and they're not necessarily tacking it onto your total loan size, but they're still basically like claiming that early so that you're not like able to default like right off the bat. But we've seen more and more people starting to do that, which is a defensive thing that we saw people do back in 2020 as well. So I think that they're definitely concerned about some uncertainty.
I also feel like, and this was just an opinion, I don't have any facts on this, just based on the conversations we've seen and had, Mike, is like, I feel like there's more and more big money coming into the private lending space.
Yeah.
And with that, these finance bros have like little nuanced ways like, well, if we did it this way, we could, we get a little bit more spread on it, those sorts of things. Or like, well, if we did it this way, then we could package this one up and sell it because it would fit this person's needs. Like they're just taking, instead of a holistic real estate underwriting view, they're taking that and then layering on like a finance view of it because there's so much institutional dollars coming upstream where I feel like during the last little run up, 2020 till 23 or whatever, you saw it coming from the iBuyers and stuff. That's where the money was at. It almost seems like a lot of that dollar has shifted like up above that. And now they're just in the lending stream, which is probably a lot less risky for people than trying to buy 10,000 houses across the country.
Yeah, I would think so.
It's just a feeling. I don't know. It seems like that way though.
Well, I mean, it's levered from the second you buy it, right? Like if you're buying the actual assets, the market turns over, you're in trouble.
Mm-hmm.
If you're going and you're buying debt, it is levered by real estate and it's only, 75% of what the real estate's actually worth. And you make the person go and pledge their entire portfolio and their unborn child.
It's all cross-collateralized. Yep.
Right. It's much better collateral position.
Yep.
Yeah, rents are due. Like, the rent's per each and all that stuff. The one thing annoying about a bunch of lenders is if you try to like shop, they're like, they want you to have like, if you had 5 lenders, you'd have 5 different bank accounts at each different place, which is super annoying.
That is annoying.
I don't try to do that anymore. I basically like refuse.
If you're going to banks, just come do it with us, bro. We'll get you. I don't give a shit where you have your bank.
Hey, you're going to get a shot at the next one. My 8 unit. So
yeah. Are we going to do a DCR for you?
Yeah.
Maybe if you can beat my go-to lender.
We'll beat them.
Yeah, we might be able to. You just got to give us all the numbers. And what I do is I just fuck around with like their calculators until I get something that I know will look better.
Mike's like, it's cheat codes. He's just trying to find the cheat code in the macro.
I'm just the exploiter over here. Like literally everyone that sent me stuff, I'm like, I'll say, send me like your best offer. And even if we don't really make anything on it, I want to do it just so I beat them.
Yeah, exactly.
It's Robbie's the one that's doing all the work anyway. It's not like it creates any work for me.
That's funny. We had as a quick aside, we had one of my washing machines broke and we own these in one of my apartment buildings. And I posted somewhere, I was like, who's people going to for laundry machines? And someone was like, oh, are you doing coin laundry? I'd get this and this, but I wanted the card reader ones, like instead of just doing coined. And they're like, well, if you have to go and get it, I was like, I have people for that now. I like use like Robbie does your work. I was like, I don't go and get these coins anymore. Like my property manager does it. So this was like, I don't care what it costs. Is what's the best deal out there.
Yeah.
Someone else would grab the quarters.
Yeah.
See, that's how you know that you're in power now is when you have them as inconvenient, but you don't have to do it. You're like, that's fine. Someone else would do it for me.
If I was getting coin op laundry, I would just want them to bring me quarters to my house. I would just want buckets of quarters.
You would want to do that.
I just want like 400 pounds of quarters just sitting in my office. It would just feel satisfying.
Why?
It's just satisfying. I love quarters. I don't know. I have since I was a kid. Like it's a good coin.
You're kind of a hoarder.
Your 50 state quarters all in your room somewhere.
No. I don't nerd like that. I just I don't know. Pile of quarters.
Dan is kind of a hoarder, though. A little while ago, he sent me a picture of his dump trailer that was literally 100% full with RTS mailers, like years worth.
Oh, that's funny.
Yeah, but where am I gonna put it? That's the question. I don't want to put it in my garbage can.
You throw it away.
Oh, really? I should. So then, okay, I have a family of 4, so my garbage can gets filled pretty quickly during the week. I don't have room to put 6 boxes of RTS in my fucking box.
You're probably not allowed to have open fires out there, are you?
No, God, no, dude. No.
But literally, it's this massive dump trailer.
It was a lot.
What you do is you just like, when you go for a walk every week, every night, you like put a bunch of them like in your pockets and you just go and drop them in your neighbor's recycling bin.
So that's smart. I should have done that. Side note, I did put a recent batch in my recycling bin and it got windy because where Mike and I live, it gets windy sometimes. And it fucking blew them all over my neighborhood, dude. Like all over them, like 10,000 RTS.
Oh my God. We've created an ecological crisis with all of our wasted mailers, too.
Yeah.
Like, how big is your dump trailer?
It can hold a lot. Like it's big.
It hold a lot. Like we've like junked out whole houses with this thing.
It can hold like, thousands and thousands of pounds of weight with it.
Yeah. It was like overfilled with fucking mailers.
Not only am I thinking how much money you spent in all of those, but how much money is in all of those. Like there's got to be deals. Start sifting through there.
Oh yeah. 100%, dude. There's definitely deals. There was 100 deals.
Do you got kids, Dan? Like just go through and have them type in the addresses to your CRM and see what they've sold.
Yeah, right, dude. Kids these days don't know how to do that. They're all iPad kids, you know?
Yeah, that's true. Yeah, I mean, there's so many of them. You can't even get a Filipino to do that.
Yeah. My daughter, so we set her up on like Facebook Messenger. So like if we get her the iPad, like when I'm traveling or something, she can message me. And she gets so lazy sometimes she'll just send me voice memos. I'm like, come on, like with like 3-word responses. I was like, yeah, that's this generation for sure.
Man, she's already sending voice memos. That's like one of my biggest pet peeves. I hate when people send me voice stuff.
I want to make sure she do that.
I'm going to also communicate with Mike exclusively in voice memos going forward.
Yeah. What if you're driving and you can't read a long text, you know?
So here's actually the great thing about how phones have come along is you can send a voice memo and it will convert it into text.
I'll transcribe it for you. Yeah.
So that's fine. But man, after a long time, like literally if you call me on my phone, my voicemail says, do not leave me a voicemail. I will not listen to it. That's literally what it says. I'm like, text me. And then every now and then I'll get like a text from some random number and it'll be like, hey, I'm from the bank. I just tried to call you and I heard your voicemail. So I'm texting you from my cell phone.
Like they're having to secretly text you.
Yeah, it works great.
Works.
Yeah, I'm like, perfect. Yeah.
Will not call you back.
So, I mean, tying this all back, guys, I'm trying to figure out, it's really hard to see what this looks like in the next 3 months, 6 months. And even 4 years, right? If the new administration comes in, like all this could be reversed quickly. But I getting my 50,000 foot view and how I'm viewing investing specifically in my market is things are probably going to be more expensive 5 years from now.
Mm-hmm.
It's more inflationary environment than not, just by default. So what's good is hard assets and then just keep reinvesting in my own business, my own skill sets, hire some more people, and then hopefully take that money from the massive income and pour it back into more apartments, more buildings.
Yeah. I think it's reasonable. Stick to what you know. I didn't hear you say that you're banking on retiring off a passive income in the next 6 to 12 months. So that's a good thesis.
I don't know. I think I'm too bougie for that. I want to have like a passive income number like 25 grand a month. That's hard to do.
Nah, dude, it's like 2 million in debt. It's easy.
Yeah. Well, are you true? This is true. I would add like to what you're saying there too is like, the idea that people have around like real estate and investing, I think in our business, a lot of times what people got us here, it's investing and you think it's a business, like the rental property stuff. It's not a business. You have to have a business around it, but it's not a business. It's an investment, right? And so whatever your investment thesis is, if it is to collect rental properties and all that sort of stuff, I agree with you. It'll probably be worth more in the future. And if not, there'll be some other tangible value you can get out of it. It just has to be part of your thesis. In the near term, if you're trying to get cash liquidity, you're trying to grow cash, 100% what Mike said is like, you need to be investing in your business and how you can grow that cash. Your business not being rental properties.
I'm doing another podcast. Like I'm being interviewed by someone that's local to here. And one of their preemptive questions on there is, if you are a newbie investor with $10,000, how would you advise them to get started in real estate investing? My answer is going to be don't.
Yeah.
So they'll see how that gets receptive. But
casino, you're better off taking that $10,000.
Yeah, go put it on black.
Filming it and putting it on YouTube of you putting it all on black.
Yeah. What you do is you go and you hire a marketing company that helps you figure out how to sell feet pics. You're going to you have a much higher likelihood of success than trying to get started in real estate right now.
That is part of my strategy. But outside of the feet pics, to add my thought on all these sorts of things is, I've actually thought about this recently. It's interesting because like there's a lot of different paths. Like if you game theory it out, what could happen? There's a lot of different paths that could happen, and you're really building your thesis off of what you think is the most likely in the game of the economy in the world and all that sort of stuff. And there's always an alternate to what other people are saying in the way of like, so you could say the tariffs are going to increase. Like one of the big conversation, I think Dylan, you had this in your notes, was like tariffs could increase the cost of building.
I mean, yeah, makes sense. Which also could make your insurance premiums go up.
It could, right? The alternative to that is like, okay, so tariffs, generally speaking, wouldn't it be a 1-to-1 costing? So if you have like a 20% tariff, the product, say it's lumber, which is a big one because you have Canada north of us. Like, I don't know that lumber gets 20% more expensive, right? It might get more expensive.
Right.
I don't believe in the whole like, well, it'll just, some of the commodity stuff of this will happen, but it's not like, oh, we're going to bring U.S. manufacturing back. Well, that doesn't help me make more money today or tomorrow or next year, maybe 5 years from now, because it takes a long time to build these factories, right? So I don't buy into that, but it might shift some of the commodity creation. But back to my point, which is, it's not going to be a one-to-one increase if it does increase it. But also at the same time is the economy is going downwards. And if people are claiming that's because of the tariffs, then the tariffs are actually bringing the economy down, which is bringing demand down, which will then bring prices down, right? And at all that happens, you'll have housing prices going down in the near term, and then interest rates will go down and follow that, because that's really the only option the Fed has to help the economy. And unemployment's going to go up, because that's been the goal for the last several years, is to get unemployment up so that we have so we can reduce the inflation. And so if inflation goes down, then prices will naturally go down. And so could the tariffs create an issue directly as far as build costs go? I don't think so. I think there's too many factors that can affect that. And so my point being is there's always an alternative story. Now, they might affect something else completely different. I don't know. But I don't think it's going to increase the cost of building a house. And this whole idea of we don't have enough houses and the demand, I don't buy into that story. So there's all these alternative stories. And I think all you can do is just continue to invest in whatever makes sense to you, whatever your investment thesis is. For me, I'm a value guy, so I'm not going to go out and start buying and putting all my money in equities, because I don't know that that's where I want it, because it's not part of my thesis. But I'll continue to find places to put it in the stock market as I see prices go to a point to where I'm like, yeah, that's a pretty good price. It's a valuable company that's going to continue to be valuable. It might be something worth looking at. Yeah, that's just kind of my thesis, is like you watch it and take an opportunity to grow and buy things as they become available.
Yeah. And I think on that same note, same thing with real estate too, right? Like you should be buying real estate that's actually valuable, not ones that you're kind of like forcing to pencil.
Or everybody's saying, buy this, storage units or whatever that asset class is.
Totally. And like what's real estate that people are actually going to have interest in over a longer period of time. I think in hindsight, looking at a lot of the people that I know that have sold out and are like, Colbert Johnson's a big person with this, right? He's like, all of his buy and hold stuff is in San Diego. He's like, it cash flows zero, but I'm pretty sure the San Diego's still going to be pretty sweet in like 10 years, 20 years. Like people are never going to not want to go to San Diego. It's got great weather. Like it's like a certain vibe down there. It's a limited area. It's not going to expand in either direction. Totally makes sense. And I think that's probably the principle if you're looking longer term. Like in the shorter term, with interest rates and things coming down and loans potentially getting more favorable, it probably makes sense to look at selling anything that you are trying to get rid of or getting ready to list those, because if rates do drop here, you're going to be seeing an increase in buyer appetite relatively quickly. There's a bunch of people that have been sitting on the sidelines waiting for more buying opportunities, and that's going to come from lower interest rates. All of a sudden, DSCRs are going to be better. Things are going to be more affordable. And so that's something to think about.
Even when the word gets around too, Mike, I would go to even a seasoned investor and said, do you know what DSCR is right now? I bet them to say 7%, not knowing that they can get it at the high 5s, low 6s.
Right.
Yeah. So, it's time to think about that, just sort of big picture. And then if you have like any real dogs, like ones that are dragging you down, get rid of them and leave them for the next guy. Leave them for the next person who needs to learn their own lessons that, the property's probably not going to be as valuable as they think it is. And that quote unquote cash flow that they're getting is really just going to go to maintaining it. You already learned that lesson. It's time to move on and give that to the newbie.
Yep.
So cool. All right, guys. Well, thanks for listening. Go ahead and share this with anybody who has interest in real estate or anything else. And we appreciate all you guys checking us out today. So thanks, everybody. We'll talk to you guys next week.
See you.
Thanks for listening, everyone. If you want more from us, you can shoot us a follow on Instagram. I am at Mike_invest. Dan is at InvestorManDan. And Dylan is at Dylan_does_deals. Shoot us a follow and send us a DM to let us know what you think of the show.